Hey, Dan Passarelli here. A lot of people have been trading AMC over the past week or so, and a lot of people have been making money in it. Some people have been losing money in it. And so I wanted to share a couple of ways that this can be traded and talk about a specific risk. I want to talk about the risk of a margin call, which is a very unique risk to situations like these and one that needs to be heeded and needs to be avoided. So AMC is one of these meme stocks, and there are many people, particularly in the Reddit community, who watch this, and they sort of collude together in a way to drive the price higher to shake out the short sellers, right? So take that for what it is, but that's what's happening, and that's why this stock has gone up pretty greatly. Now, it's experienced a great deal of volatility lately. Now, if you look at the option chain, the front expiration that expires in about 4 days, it actually goes all the way up to $145 a share, right? Now, this stock right now is at $58.90 a share. And look, the market is a penny wide. It's very, very active. There was almost 100,000 options that traded at that strike today with a 462% implied volatility. This stock would have to rise 80 points. That's about 150% or something, 130% or something like that in the next 4 days, which of course is possible, but it's extremely unlikely. And so there are some folks who may decide to sell calls in there. Now, selling a lower strike call can maybe get you a higher premium, and typically, I would say that could potentially be a good idea because you could do a spread. But when the implied volatilities are so high across the board, and especially when they're higher, the higher the strike you go, you can't really do a credit spread. Like normally I would say, we'll sell the 120 calls and buy the 130 calls, but you'd only collect 20 cents on a $10 wide spread. That's insane risk reward. That just doesn't make any sense whatsoever. And so what some people will do, and this is a high risk trade, but it's one that with calculated risk could make sense for some people, and that's just simply selling naked calls, the highest strike. Now, this is one where theoretically there's unlimited risk. So warning, warning, warning. You want to be very careful with this and monitor it very, very closely if you make a trade like this. Now, I really want to talk about some of the risks though. On Friday, I was monitoring AMC. If you had naked call positions in AMC with any strike, okay, with any strike, what some brokerage firms did is they drastically increased their maintenance margin requirements. That means, so look, whenever you sell a naked call, whenever you sell any option position, you have to put a certain amount of cash reserved in margin in case the trade goes against you. Now, because AMC was up quite a bit yesterday, on Friday, I want to say 15%, I think the brokerage firms really kind of got a little bit nervous. And what they did is they raised the margin requirements immensely. Why this could be a risk is whatever your account size is, if you have a big enough position in AMC, you could potentially be making money or maybe be down some money. If the trade goes against you a little bit, your broker could require you to close out that position. And if the trade is against you, that means your broker will require you to close the trade out for a loss. That can lead to a forced loss, maybe one that you wouldn't otherwise take if you were just simply monitoring your risk. With the stock this far away from some of these really high strike prices, you know, the stock rising $6 on Friday or whatever it was, $9 today, it's something that a lot of people could stomach. You might not sleep as well, but you might choose to keep that risk on, but your broker tells you have to take it off. And that's their prerogative. And to be fair, they are being responsible, because if the stock goes to 1,000 by Friday and you do nothing, you could theoretically lose hundreds of thousands of dollars. And if they have enough clients like that, losing hundreds of thousands of dollars, millions of dollars, tens of millions of dollars, they're on the hook. And so they force their customers who have certain positions to put more money into the account or to close out enough of their position to be back within compliance. So that is a unique risk that everyone needs to know about, because it could lead to forcing you to close trades at a loss. And the way to avoid margin calls like this are just simply to keep your positions small enough that it doesn't take up a lot of margin. You've got a ton of extra room for margin, so even if they do raise those maintenance margin requirements, you're still going to be in compliance. I hope that helps. This is Dan Passarelli. Trade smart.